I'm so happy to see everybody. I want to introduce you to Miss Jean Ausman. She is with Simplicity Minneapolis, and she is going to assist us today and go over our long-term care plans that we have with Simplicity and answer any questions that you have. Right, Miss Jean?
I am. I am.
Awesome.
I've got the PowerPoint that I had for the recent Minneapolis meeting, but now since I have a little bit of time, I have all you guys as as captive audience. I get to go through the whole thing, which I didn't get to at the meeting. So I'm so glad I get to go through this with you guys.
That's very exciting. So without further ado, I'm going to let Ms. Jean take over. And definitely, if you have questions, pop them in the chat so that we can ask them at the end. And that way you won't forget them.
Fair enough. All right, I am going to. Is it okay for me to share my screen here?
Yes,
Please,
Jean, you can share
yes.
your screen.
Okay, fantastic. Let me go here and then share this. And then I'm going to go to presentation. Okay, so let's see. Trying to get into presentation mode. Okay. So what I'm going to do today is I'm going to go through and get you guys some exposure to long-term care and kind of how to talk about long-term care, what some of the options are for products, some of the real benefits to long-term care that a lot of people don't even know about, and where you guys can use it in your practice and why it's so important as we start moving forward. There are a bunch of different reasons why long-term care has kind of finally come to the forefront, and over the next few years will be just a huge, a very huge and important facet to financial planning. Okay. So this kind of summarizes what I think about long-term care in terms of the reason why you do long-term care, right? Um, when you need $1 for long-term care expenses, depending on where you're getting that dollar from, if you don't have long-term care insurance, I mean, you're going to be dealing with taxes at a bare minimum. So if you need to pull a dollar, hold on one second here. If you need to pull a dollar out for long-term care, then and you're pulling it out of your IRA, you better pull $1.40 out because you're going to be paying taxes on that qualified money coming straight out. If you're looking at non-qualified assets like stocks and equities, then you better pull or sell $1.20 because you're gonna be paying capital gains tax on that. Hopefully, if the asset has increased in value. If you're pulling it from your checking account, it's a one-for-one exchange. There's no leveraging there. But if you take the time to put money into long-term care insurance, you can be looking there at 30 cents or less for every dollar of long-term care coverage you get, or money for long-term care expenses. So it's just a matter of, in the old days when we had just traditional long-term care, then that was a use it or lose it proposition in most cases. You either use the money or it becomes like homeowners insurance, where it just goes away, and the money you spent on long-term care coverage is kind of like homeowners insurance. It was there if you needed it, but if you didn't need it, then the money just goes away. Now we have products where if you don't use the money for long-term care, you don't lose it. An asset worth at least what you've put into the product goes on to heirs if you pass away without ever needing long-term care. So it's a different situation for long-term care today than it used to be. Also, people didn't like traditional long-term care because the premiums can go up. If you've been in this market space at all for the last 20 years, I'm sure you've sold a Genworth policy or two where the premiums have gone up and you've talked to very irate clients over the premium increases. The products that we have today, even if you pay for it, pay to 65 or 10 pay or pay to 95, The premiums are guaranteed and fixed. You're not seeing a premium rate increase over time. It's just whatever you agreed to on day one is what you're going to pay for the life of the contract. So this is kind of just an overall view of why we're doing long-term care. Okay, so I'm going to touch on just the current long-term care market space right now and what we're looking at in terms of the population. We're hitting what I lovingly call the silver tsunami. You've got baby boomers, and a lot of them all getting to the point where they're going to need care at around the same time. So our overall population of people between 65 and 100, that population is growing by leaps and bounds. And the care industry, it's interesting, the care industry isn't keeping up. So demand is really exceeding supply and will continue to exceed supply as the years go on. And so the people who are going to get good care are those who can pay for it. So yeah, number of people 85 and older will nearly triple to 19 million people. 85 and older. That's crazy by 2050. So when we look at costs of care in 2021 for around an average nursing home, you're looking at about $108,000 in 2021. With the COVID protocols and difficulty getting people to work in facilities, it's just driving the cost up by an incredible amount. So you're going by 2030 up to 141. By 2050, you're going to hit that spike of people, and you're going to be looking at, by 2050, the average cost being $255,000 a year, which again is just unbelievable to me that the rate's going to go up that fast. So what I want to make sure I address here is specifically what people think, because that's what you're coming in contact with, what people think. And the sources that people ages 65 and older think of as the primary way to pay for long-term care, the vast majority of people think that it's Medicare that pays for it. And Medicare will, in certain circumstances, will pay for a very small window, 100 days maximum, of skilled care. But the key about that skilled care is to get Medicare to pay anything over that 100 days, you've got to start the whole thing with a 3-day hospital stay. And then once you're out of the hospital, they have to discharge you to a skilled nursing facility. And once you're in the skilled nursing facility, then yes, Medicare will pay for the first 100 days essentially. And if you have a Medicare supplement, it'll cover the copay that's in there. But you have to be getting better. That's the key there, is that someone who has had a stroke and is recovering their faculties, is going through rehab, is getting better and improving. That person is going to have Medicare help pay for those first 100 days. The person who has Parkinson's or Alzheimer's or just needs help with getting around and doing basic things every day, but is not improving, will have the Medicare cut off. I've literally spoken to advisors whose spouses were receiving Medicare funding for skilled nursing facility, and then their condition plateaued and they weren't getting any better. And the advisor would call me up and say, why did they just yank my wife's Medicare funding for her skilled nursing facility? It's because she's not getting better. She's just plateaued. She just needs basic, what they call custodial care, help with eating, bathing, dressing, using the restroom, bladder and bowel control, and transferring. When you just need help with those things, Medicare just shuts off. So most people, as you'll see in this next little thing here, Medicaid makes up 42% of actual sources for funding long-term care. Medicaid is not what I would say is for most of you guys with your clients having a certain lifestyle their entire lives. Medicaid is not really a great viable answer. Number one, most of the time, Medicaid means facility. You can't stay at home and get Medicaid to pay for it most of the time. You may have heard on the with the whole election just happening, there were a couple times where Kamala mentioned that she felt as though having home care as part of Medicare would be a great thing. Again, the cost for that home care for people who want to stay at home, the cost for that, we're talking trillions of dollars. So with Medicaid, you have to be in a facility. It's a facility that the government chooses for you. You have to have spent down all of your assets to essentially your last $2,000 to even qualify for Medicaid. And the part that everyone forgets about is that Medicaid is not just about assets, it's about income too. So if you have a couple that is in retirement making, having an income they can count on through annuities and, whatever other income sources they have, has $10,000 a month coming in, and one of them wants to qualify for Medicaid to have them pay the nursing home bill, it's not just that they have to spend down to their last $2,000. It's that out of the 10,000 that they have coming in the door, all but a small portion of that is going to be dedicated to paying the nursing home bill. So if they have 10,000 a month and you've got someone still living at home, the wife's still living at home and the husband's going into a facility, the wife is going to right now get about $2,800 a month to live on. And the difference between the 10,000 and the 2,800 is going to go towards the nursing home bill, and Medicaid makes up the difference between what their income contributes and what the actual nursing home bill is. So most of it, realistically, in dire situations, you're looking at Medicaid, and then most of it is out of pocket. People just drawing down their life savings to pay for long-term care. Yeah. So according to a recent LIMRA survey, 29% of respondents believe they own some form of standalone long-term care insurance or combinations of life that they can use for long-term care in advance. 29% of respondents felt that they had this coverage if they needed it. Actual ownership is closer to 3%. That is, to me, a staggeringly small number of people who think they've got coverage and really don't. And that, I guess, just really, for me, opens up the door to this huge, wide blue ocean of opportunity that long-term care is for you and for your clients. It's just, it is right now. If you're not talking to your clients about long-term care, be prepared that somebody else is going to approach them and want to talk to them about long-term care. And then if you can't be the resource for them for this type of coverage, there's a chance you can lose that client to the advisor who can be the resource for that type of coverage. So I'm going to talk about a couple different types of cases right now and how long-term care, really the government wants you to buy long-term care insurance so much that they're offering you incentives through tax deductions and the Pension Protection Act. Effective January 2010, you got a client who has an annuity that 20 years ago they put $50,000 into, and they've just let it go and run for 20 years. And now that annuity is worth $100,000. Let's just say $100,000. So you've got 50,000 that they put in, 50,000 in gain. And if they start taking income from that, they're going to be paying taxes on the gain first. So until that first 50,000 of gain comes out in the form of income, they're going to be paying taxes on it for that first 50,000. With the Pension Protection Act, you can take that original 50,000 and the 50,000 in gain, transfer it into a long-term care qualified annuity, sometimes double, triple it for the value of the annuity, And then if it does pay out for long-term care, there are no taxes owed. No taxes owed. On the basis, the gain, there's no taxes if you transfer an existing annuity with gain in it into a long-term care qualified annuity. So now you had 50,000 basis, 50,000 in gains. Now you've turned that into 100,000 triple times with like the Global Atlantic product. You can triple it into $300,000 for long-term care, and none of it is taxable. None of it for long-term care. The government wants you to buy long-term care insurance enough that they're giving you either tax advantages or tax deductions all along the way. Long-term care is the only product I know of in the marketplace today, the insurance marketplace, where you can deduct the premiums in many cases and still get the benefits tax-free down the road. So here we've got Bob, who's age 69, put $400,000, he's got 400,000 in annuity. So if Bob says, this is what I'm going to use to pay for my long-term care expenses, if he goes in to withdraw money out of that 400,000 annuity, he will pay income taxes on whatever gain is in that annuity that he has now identified as being his long-term care paying source. So he had 200,000 in basis and 200,000 in gain. He's going to pay taxes on the 200,000 in gain first if he just leaves it alone, or he can take that 400,000 basis and gain, transfer it into a long-term care annuity. And right now, annuity care, if you're under age 70, you can put money into it and it's going to go from being a $400,000 annuity to 4 times that for long-term care. So now it's got a pool of $1.6 million for long-term care, all of it coming out tax-free if he uses it for long-term care. So what this represents here is 96 months of benefits tax-free. So $16,000 a month tax-free for home health care, assisted living, nursing home. I mean, the whole gamut of care. So this shows you from an annuity care illustration. I get people asking me all the time, are those real numbers? Is that really that you can take 400,000 and turn it into 1.6 million for long-term care? And you can see right there on the guaranteed interest rate column, guaranteed. This isn't even like the high end. This is the guaranteed end. You're taking 400,000 on the left-hand side there, and you're turning it into a total long-term care benefit balance of 1.6 million. The monthly benefit here on the guaranteed side after the first year is $16,723 a month. Tax-free for long-term care. So what's driving up demand for protection? Aging population, increasing rates of cognitive decline, and personal experience of long-term care. I don't know how many of you have clients who are currently taking care of their parents. They're currently caregivers. Anyone who has even on the peripheral touched long-term care in their own lives, where they've got a parent who needed long-term care help and they're the caregiver now because the parent didn't plan, or someone who is managing their parents' care and they did have a long-term care plan, so they've got money for it, so they don't have to be their parents' caregiver. Any of those circumstances are going to be people who understand the need for this. So the long-term care experience for 75% of Americans, witnessing a family member receive long-term care was a major reason for the decision to purchase long-term care. As a first go-round with your clients, I would just poll your clients individually when you're meeting with them. Have you guys experienced long-term care in your lives? You know, do you have a parent that you're caring for? Even having a special needs child that they're caring for makes a big difference. And 52% said peace of mind is a significant factor in their decision to purchase long-term care protection. And the government is preparing. I don't know how many of you guys know what has happened out in Washington State. The Washington CARES Act 2021, Washington State, 58 cents on every $100 you earn is going to pay for a long-term care payroll tax in the state of Washington. No cap on that.
Wow.
So it's currently they've changed the rules on it to make it portable now. So if you pay into it for 20 years and then you move to Texas or Tennessee or Florida, you can now take with you the gigantic benefit for 1 year that they're giving you at the end of the rainbow here, which is a total of $36,500 to use towards long-term care. And you have to use that prior to accessing Medicaid. The whole point of the Washington CARES Act to set up this tax for long-term care was to delay people going on Medicaid and the Medicaid funds being drawn down as we have this silver tsunami of people. So now you've got 12 more states. So this is all, driving people towards looking at long-term care insurance. Because one of the only ways you could get out of the Washington state tax was by owning your own long-term care plan in a certain amount of time. So we talked about the expenses, the years, first baby boomer turning 65. It's just absolutely astronomical what the expenses are for long-term care. In 2021, 40.1 million baby boomers age 65 and plus. And in 2026, the first baby boomer turns 80. The average age of claim right now is about 83. So, and just to show you the home health and personal care aides, it's amazing to me in terms of the projected growth of US jobs. Home health and personal care aides make up 12% of the net growth in jobs over the next decade. That's just an amazing, amazing statistic there. And you're going to need people who can be caregivers. As the child of a parent, or as the parent, you don't want to rely on your family, if at all possible, to be a caregiver. As you're going through the month of November, what I mentioned to people at the Baltimore seminar or meeting was that all of these different links I can get you if you want to put on your social media or send out a letter to your clients marking the fact that November is Long-Term Care Awareness Month, and go through some of these articles. Send them a link to some of them. I have a link to a full 13-minute YouTube video that if I was back out there selling right now, I'd be making people sit and watch. It's a story, 60-minute story of a couple going through the wife needing care for Alzheimer's. Spans 10 years in 13 minutes. And the story is not what happens to the wife who has Alzheimer's. The story is what happens to her husband who has to be the caregiver because they don't have long-term care insurance. I mean, it's just amazing. Okay. So if you want these links, just let me know and I can get them to you. So we've got Asset Care in 2024, which is the new Asset Care product. They took all of my concerns about Asset Care, that it was a little confusing, complicated, that the leveraging, you wanted more for long-term care leveraging. You wanted to be able to use some of this in cash to pay whoever you wanted to pay to be your caregiver. And let's see, should I go up to here, these chats? Yes, send that. Okay, great. We'll do. Uh-huh. Okay. The Asset Care enhancements, I'll go through an example with you. But the price decrease for all continuation of benefit policies electing full inflation protection, there was a 12% average decrease for the continuation of benefit policies with any inflation protection. And for issue ages 50 to 70, the prices went down. 25% decrease to a 9% increase with no inflation. And 45% decrease to a 2% decrease for full inflation protection. So we'll look at this. And again, I know you guys are newer to these policies, so I'm happy to go through individually with any of you, how these illustrations look and how the product works. But just to give you a basic idea, we started off, if you had any exposure to One America, the acceleration of benefits, or the AOB, could be 25 months, it could be 33 months, it could be 50 months, and it was very complicated. So they simplified it for everyone now. Doesn't matter if you're buying it as an individual or a couple, that acceleration of benefits, meaning spending down the death benefit, is going to happen over 24 months, 2 years. And then the options for the continuation of benefits, or what's available to you for long-term care after the death benefit is used up, you can add on an additional 2 years of benefits, additional 4 years of benefits, 6 years of benefits, or what makes sense most of the time is just doing a lifetime continuation of benefits rider. There are products out there that do full cash, and you're going to find over time that you're going to be able to figure out with your clients, what is my client's main priority? Is it having lifetime benefits, or is it having a totally cash policy? Okay, message, video link pop. Yep, absolutely. Get that off to you without a doubt. So I'll look at these after we finish here, and then I'll get you the links, and I'll get you the link to the YouTube video. Super powerful stuff, super powerful stuff. But again, going back to the One America Asset Care, this is how, whether you're an individual or you're part of a couple, these are the designs available to you. That's it. And it's so much easier now.
If you want to send those links to me, I'll email them out to everybody.
Oh, fantastic. I really appreciate it. Thank you. Thank you, Wynn. All right. So the cash benefit, while you're using up your death benefit amount, you have the option of taking 75% of whatever the full reimbursement benefit is. So let's say your reimbursement benefit is $5,000. You can take 75% of that in cash instead of the full 5,000 reimbursement. And then it'll take you a little bit longer, because you're only using 75% of the benefit at a time. It'll take you a few months longer to finish off that death benefit before you go into the continuation of benefits rider. But when you think about it, when somebody needs care in the very beginning, that's when you're depleting the death benefit. That's the first thing you deplete. The way a claim progresses typically is that you don't need as much care in the beginning as you may need down the road. So in the beginning, if you want to have a family member lend a hand and pitch in, then that's in the very beginning is when the only time you would want to do that. And using the cash benefit, you can literally compensate a family member to care for you while you're depleting the death benefit. And then after that death benefit is gone, then you're into full reimbursement benefit. And typically after the first year or two of needing care, of some kind of care, you don't want a family member caring for you if you're still needing care after that period of time. You want to hire someone who is a professional who can be a caregiver to you, that is, again, not a family member. So you've got the cash benefit now with the asset care. They're actually, One America is now paying for a caregiver consultant. You can have someone come in either virtually or in person up to once every month to assess the type of care you're getting and make sure that you're still on track and you're getting all your needs met. Up to once a month, you can have someone come in to your home and just do an assessment. They're allowing for independent providers now. So as long as it's not a family member and they've got some kind of certificate saying they've been trained to be a caregiver, you can pay someone with the reimbursement benefit from this policy. So, and they will take you out of the billing process and work directly with your caregiver to get bills paid. So you, as the insured, or your family, don't have to be in the middle of that collecting bills and receipts every month to turn into One America to get repaid. So expanded care concierge services, you got your care coordinator, your care consultant who can come in up to once a month to check on you, make sure you're getting the right amount of care. I mean, it's absolutely just the most care type of coordination that I've seen with any carrier out there. So these are the states right now where the new asset care is available. It's coming to the gray states soon, but it should be, other than Indiana, South Carolina, and Florida, that should cover most of what you guys are looking at. But, and again, this should be very soon that it's getting into the other states, and they'll kind of announce them as blocks of states. But it's already in effect for, all the blue states. We're not going to go through the transition, but we will go through how long-term care appointments are different than maybe a life insurance appointment is. We've got various different lead generation strategies and programs at Simplicity. We can, Don Quante, which I'm sure everybody knows Don. Don Quante wrote a book fairly recently called, well, he wrote the original Don't Go Broke in a Nursing Home. And then recently he wrote Tax-Free Benefits for Long-Term Care in a Post-COVID World. And we have that in a 150-page PDF. And we can now, once you're contracted with us, we can get your headshot and your bio on the back of that book, and you can send that out to whoever you want to send it out to. And it's not co-authoring, but it's co-branding. So essentially your information is on that book and you can associate with it that way. A lot of people end up giving away the PDF of that book for people who do the survey, the long-term care survey that we've come up with, that we can help you sign up for as well.
Is there a cost for that, Jean?
No. If you're contracted with us, the book would normally be like 400, I think, and it's free. And the survey, getting that set up is a few $100s typically. And we do all of those, once you're contracted with us, we do all those services and get those all set up for you, no charge. Our marketing department works very closely with us to make sure that those programs get set up exactly the way you want them set up. And now we're actually, with the LTC survey, I've got people who are actually putting a QR code that when you hover over that QR code on your letterhead or on your signature line or on your business card, that QR code will take you to the long-term care survey. You answer the questions on the survey, which are essentially, do you know someone right now who's receiving long-term care? Number two, have you known someone in the past who's needed long-term care? Number three, if you needed long-term care, where would you want to receive care? Everybody says at home. What asset would you liquidate first to pay for that care? And then if we can show you a better, more tax efficient way of using your assets to pay for long-term care, is that something you'd want to know more about? And, people answer those survey questions, and the responses to those survey questions with their phone number and name go to whatever email box you give us that you want the responses to go back to. So again, I've got people with QR codes now who are putting QR codes on everything, and people are taking the survey kind of left and right, because suddenly someone is in front of them with the topic of long-term care and they realize, wow, this is something we haven't addressed yet. We better address it. So that you've got the lead generation. The first appointment, you're going to utilize the 3 critical questions of, if you needed care, where would you want to receive it? How would you pay for it? And then again, the question of how to move forward with these programs. So you would send the fact finder with the health information, the first step, completing the health information, you'd send that to me at Simplicity. We analyze those and let you know, essentially based on the health information you've provided for the client, and you can put their initials on it, put the month of their birth and the year of their birth. We don't need any of the details for who it is. We just need the profile of the client. We can get back to you with what that client will qualify for from a medical standpoint in terms of a long-term care. Is it going to be a life with long-term care? Is it going to be an annuity with long-term care? Is it traditional long-term care? We can help you with that. On your second appointment, I mean, on that first appointment, you are not bringing out any illustrations. You're just gathering health data and having the conversation about the importance of getting this covered. You're not talking about actual numbers and showing illustrations until the second appointment, where by that time you and I have gone through the illustrations. I've explained to you, how to show your client how these work, how to go through the illustration with the client. And then hopefully by the end of that second appointment, they're ready to say, hey, you know what, let's see if we can get this done and do the online interview or the online application. And then we get the decision on that. And by the end, you're doing policy delivery. It should be a pretty relatively quick process, but you have to have patience with it at the beginning because it's not the same as signing someone up for just life insurance, where that gets paid out if someone passes away, and it's all pretty cut and dry. I think eventually long-term care insurance is going to be as required and as necessary to your clients as homeowners insurance, life insurance, car insurance is today. It's going to be that important. When you do deliver the policy, I would recommend that you have the kids involved, as long as they're old enough, the kids involved the whole way. I mean, through the policy delivery, you want them there. You want them to understand that their parents have this policy, how the policy works, how to get it started. And then I will be the first to tell you that by inviting your 20 or 30-year-old kids into that meeting, you open up an entirely new generation of potential clients for you. They know their parents trusted you to do a long-term care policy with them. You help them understand how that long-term care policy works and how it's going to save them from being a caregiver someday. And now they're calling you up and asking you, should I have disability insurance? Should I have life insurance? What type of life insurance should I have? It's an entirely new generation of potential clients. So that's the fact finder. This is kind of what it looks like. It's showing you the in-home care, assisted living, nursing home care, and you're just doing the math on that in terms of what they want to protect for. And then you're boiling down where the assets are. Because again, if you've got someone with a highly appreciated annuity, an annuity with a lot of gain in it, that can be used on a tax advantage basis. If they've got money in qualified plans, we can actually use qualified money to generate long-term care benefits. There are a whole number of different ways that we can use assets to create long-term care benefits. We just need to know where the assets are and where it makes the most sense to take them from to build a long-term care. And this form also gives you the opportunity to show your clients or have them sign saying, you know what, Wynn showed us long-term care today, and we've decided not to pursue long-term care coverage, but our kids can't come back and sue Wynn down the road for not showing my parents long-term care coverage because Wynn has this form saying, on today's date, I showed them long-term care, they chose not to proceed with it, and that's their decision. The three critical questions: if you got sick and needed long-term care, where would you want to receive your care? Most people say my home. Which asset would you liquidate first to pay for care? An annuity potentially. And if I could show you a better way to use your annuity to pay for care, is that something we should look at? Those are three questions where you at least want to get to the first one there. If you got sick and needed long-term care, where would you want to receive care and how are you going to pay for it? critical questions. So, and then on the second appointment, this is kind of the next steps. We're, funneling down which product to go with there, looking at health. So this just takes you through the different product appointments and application, when you're doing the application, and how you're delivering the policy. And again, go through second appointment. So that is pretty much my presentation for today. Again, if you have qualified money that you can identify, if you have annuities that you can identify, if you've got, pretty much any asset out there, we can leverage it to turn into more money for long-term care. And especially if you work with small business owners, someone who owns an LLC or an S Corp, or if someone owns a C Corp, I get up and I do a little happy dance for you if they own a C Corp, because the tax deductions for small business owners or C Corp owners are just absolutely huge. So understand that there are going to be tax deductions for a lot of these people, in addition to getting long-term care benefits tax-free. Huge, huge benefits. So I can answer whatever questions you guys have. We have a few minutes more here before the end here. When did you want to open it up to questions? Hey there.
I have to unmute. Absolutely. Sorry. Can you guys
Sure.
hear me?
Mhm.
Okay. Randy's got the first question.
Go
Gene,
ahead.
hello, everybody. I appreciate everybody showing up. Gene, I just want to express the fact that knowing how to get into the long-term care conversation
Mhm.
is an art in itself.
Oh, it is.
And every one of our people here have been trained to introduce it in their estate planning sales presentation.
Fantastic.
So my question for you, and it may be too hypothetical, but I've
Mhm.
got one in the morning. I'm not sure what to do with. I have a healthy wife and a husband who's had COPD and a mild heart attack.
Mhm.
Okay.
Yeah.
She
There is a product out there, depending on what state you're in, for
Tennessee.
in Tennessee. Okay, I'm pretty sure we're good with this then. The Bridge product by Equitrust is out there. And that offers, how old is the husband, just out of curiosity?
He was born in 1952, so that makes him 74.
Okay. There you can get leveraging. So for every dollar you put in, you can get, I'm not sure what the leveraging percentage is, but there is a product that you can get with no underwriting. And it leverages your money into an annuity to be paid out for long-term care. But again, if you're in great health, they'll do more than tripling what you put in. If you're in pretty good health, they'll more than double what you put in. And if you want no underwriting, then it's somewhere between like 1 to 1.5 times what you put in for long-term care that will be paid out in a cash benefit, tax-free, in an annuity that's growing over time. The other option there is that I would probably want to look at doing a cash benefit policy for the wife and just kind of souping up her coverage. Because if you do a product that has a cash benefit, by definition, they're not analyzing they're not looking at bills for where that money is going. So if she doesn't need care, then nothing happens. It doesn't benefit him at all. But if she starts receiving care and he also starts to need care at that time, or has needed care for a while, and she may have been a part-time caregiver up until that point, then there's extra money there. There's enough money hopefully for her care and maybe a few dollars extra left over to help contribute towards his care. If he needs care and she doesn't, then chances are she can pitch in a little bit and help with his care, and maybe their care bills won't be that high. Where they're really going to get into trouble is if they both need care. If he needs care and she can no longer be a part-time caregiver, Now they're expensive to have gone up dramatically at that point when she can't be a caregiver and they both need care. So I would either get more coverage than is needed on the wife, or I'd look into, and I'm happy to send you information on the Bridge Equitrust or the Equitrust Bridge product with the no underwriting on it.
So, if we, do you, okay, like we send Mike and Les a scenario and they send us back the 3 top. Is that something we can do with you, or is that too much on your plate?
You're gonna want to kind of, I mean, you can copy me on whatever you want to send, but you definitely want to send it to Mike and Les first. The key there being that to really plan for long-term care, most people can't afford or don't want to afford to insure the entire risk, right? I mean, you're going to have some amount of income with annuities that you've set up or other income streams that you've set up at that point in your life. So you just want to insure for the gap, right? The difference between what coverage cost or what the care costs and what the income that you've already planned for through annuities and whatever what other avenues for income you've set up through Mike and Les. So you're going to want to solve for the difference there. And usually that comes in after the income plan has already been established. So you're going to want to include them on everything to make sure that they, are able to advise on that side, the income side.
Jean, can you tell me a little bit about the age restrictions? Is there a too old to buy it? And is there a premium restriction to little money?
No, typically if you're doing, if you are in your 70s, I'd be looking at doing an annuity product because by the time you get into your 70s and you're looking at life products with long-term care, you're really getting hammered for the fact that you're in your 70s and you're looking at a life insurance product. You want to look at an annuity because that's going to give you more leveraging even though you're in your 70s. If you have some health issues, I'd be looking at an annuity product, specifically because all of the annuity products that we work with, the most underwriting that those products require is a phone interview, a prescription drug check, and that's it. Phone interview, prescription drug check. There's no paramed on the annuities. There's no medical records being requested on annuities. It's just a phone interview and a prescription drug check. And if you feel as though your client is not going to do well on a paramed or having their medical records looked through, you want to go the annuity route. There still is some medical underwriting on that. And really anyone who's healthy or in their 60s or younger, you're going to want to look at doing a life product on. Because they can take advantage of their youth. They can take advantage of that. They're still young enough to get good leveraging when you're in your 50s and your mid to lower 60s. But typically when you get in your upper 60s or your 70s, you've already got a couple health issues maybe going on. Your attending physician statement records are a little bit bigger than when you were in your 50s. So yeah, you kind of want to look at those two age groups a little bit differently. But typically I can do an annuity on someone into their lower to mid 80s. And I would start the conversation with people, just bring up the subject of long-term care. What's your plan for long-term care? Let's go through your written plan for long-term care. Just ask that open-ended question. What's your written plan for long-term care? I start asking that question when they're in their early 50s.
What is that book called?
Oh,
You
the one that
referenced?
Don wrote?
Mhm.
Tax-free benefits for long-term care in a post-COVID world. Don Quante also wrote the book Don't Go Broke in a Nursing Home, which most of us have, if you do this as much as I do, you've heard of. So
I don't want to hog the question, so I'm going to hold
yeah.
mine until, unless, if someone else has got a question, go ahead and ask it.
Hi, it's Liz McGovern. I have a question.
Hi, Liz.
How are you?
I am good. How are you?
I'm well, thank you. quick question. So I've been
Yes.
talking to Mike about two 60-year-olds who
Mhm.
have some, we're talking about moving some qualified money into the most current product. And I'm
Yep.
just confused. You're talking about, it seemed like we were doing a combination product of both annuity and life.
You are, you are, you
So
are.
explain that difference between what you just suggested to Randy about age, go for the annuity, or health issues, go for the annuity,
Mhm.
otherwise go for the life. It sounds like we're doing a combination. So could you just explain
Yeah,
that a little more clearly?
yeah. And that is kind of the one exception is if you're working with qualified funds, essentially what's happening is you want to leverage whatever money you put into long-term care to get more money for long-term care should you need it down the road. And if you're using qualified funds, you want to make sure that you're not paying taxes on those long-term care benefits.
Mm,
So the only way you can do that is by, I mean, if let's say you move $100,000 of qualified money into this plan for two 60-year-olds. That
mhm.
qualified movement of $100,000 over, first of all, they don't want to get hit with a tax bill for moving 100,000 of qualified money over, right?
Right, right.
So that's where the annuity comes into play. The 100,000 moves into a qualified annuity. So it's like to like. It's going into One America's annuity, an annuity product that is a qualified annuity. And then over a 10-year span, which is just how their product is set up. So if you've got someone who's got a brand new inherited IRA, it works, it works perfectly. So over 10 years, that money is withdrawn, kind of systematically within the annuity. You're moving 10% of it over into a life product. So as the money is moving into the life product, you're making it non-qualified 10% at a time. You've got 10%, or let's say $10,000 qualified funds moving out of the qualified account. You're taking 1/10 at a time and you're paying taxes. You're getting 1099 on 1/10 of that $100,000 asset that you moved over like to like. So there was no tax consequence on the major movement of the 100,000. You've just got a tax consequence on 10% of that money each year that you're paying taxes on, and turning it into non-qualified money as you're paying taxes on it. As that money moves over from the qualified annuity into the regular life product called asset care, it's now non-qualified funds and it's buying a life policy with long-term care benefits.
Okay, understood. And so here would be my question then. What if
Yep.
a year, 2 years, 3 years, whatever, less than 10 years, the
Mhm.
client either needs care or passes away? What would be
Right.
the tax consequences to any of that?
Right. So let's say in year 5, and to make it easier, let's just say this is individually owned. Okay, this is one
Yep.
person owning this policy, and in year 5, let's say this person needs care, right? This product has waiver of premium on it. So as long as that person needs care, all they will have had to do is move over those 5 payments, 5 years of payments, and pay taxes on now 50% of the 100,000 because they've 5 payments over, right? And they've paid tax, they've been 1099 5 times, 10% each year. If they need care, there's waiver of premium. So those movements out of the qualified annuity and into the life policy stop. And the life policy is considered fully funded, meaning you have all the benefits you were entitled, you signed up for the day you signed up for the policy and said, if I need care, this is how much I'm going to be getting in terms of a benefit. And those remaining 5 payments that didn't move over into the asset care stay frozen in that qualified annuity. That, I mean, technically they could, after a certain period of time, they could take income off of that original qualified annuity. They don't have to complete the other 5 payments to qualify for benefits. Waiver premium. The premium is waived They've made their 5 payments, they've paid taxes on those 5 payments. The other 5 payments stay in their original qualified annuity and just sit there. They can be eventually taken as income. They can be left to an heir. If they die, they're left to an heir. Like if in year 5 the person dies, again, you've
They would get the life benefit though, right?
they'd,
If in
they'd
year
have the
5
life benefit if the person died. They'd have the life
Yeah.
insurance benefit, and
plus the
they'd
annuity.
have a $50,000 qualified annuity coming to them, the heirs.
And so the heirs would be responsible for the taxation on that though, not the
Correct.
life, obviously.
Correct. Not on the tax-free death benefit on the life policy, but on the original, that 50,000 that's still sitting in that qualified annuity that they just inherited, they would be responsible for the taxes on that. Correct.
Okay. All right. Thank you, Jean.
Sure. Did that, it's, if you can get the gist of that, you can get the gist of that product without looking at the illustration and seeing it all kind of play out in front of you. It's the most complicated product I work with. So if you think you get it, that's yay. You're about
We
18
may
months
be
ahead of where I
conversing again.
was. I'm sorry?
We may be
That is-
conversing again.
Perfectly fine. If you just get the gist of it at this point, like theoretically,
Yes.
it is the most complicated product I work with. It takes a couple times of repeating like the series of events to really catch on and say, oh, I get it now. Doesn't
Thank
happen
you.
first
I
time
appreciate it.
usually.
What's the
Jean,
maximum age on the using that hybrid product where you're going annuity to life? What's the maximum age on that product?
79, I believe, on the annuity to life. Not, I believe it's 79, sorry.
Which one
But
did you
you
say
can
that they can
use-
use up into their 80s?
Yes, there's another annuity not using qualified funds, but there are other annuities like just annuity care with One America that I can use up to like 84, 83, 84, if the person's still in halfway good health. Yeah, but the qualified funds product, you're funding a life insurance policy at the end of that, and that cuts off at 79. But you know, I would say on that you also keep in mind that you can use that 10% that you're paying the taxes on each year that you're getting 1099 on. You can use that to help meet RMDs also at a certain age. I mean, it doesn't mean anything until you hit that age, but you can use it to meet RMDs or can qualify to meet your RMDs.
And there, let's just say that one of our licensees sold a $200,000 asset care and got it
Mhm.
issued to a 70-year-old male. What do
Mhm.
they earn?
There is it depends on how they're paying for it, how the client is paying for it. And I don't know, typically on single pay asset care, like if they just put $200,000 into an asset care policy, it was fully funded, the comp on that is 8% of the single premium payment.
So they'd make 16,000.
Mhm.
Okay. So can they make a $200,000 payment down up front and then maybe a monthly payment too?
You can do that. You can do a lump sum and then fund monthly, like you can do a lump sum for like the death benefit and then pay monthly for the continuation rider. You can do combinations like that. Absolutely.
And again, I just want to stress to everybody, how can you not wind up in a long-term care conversation if you properly follow the family tree asset positioning go-to first interview?
Yeah.
And you know, we give you all the wording for that. And every client I talk to, I ask the simple question: tell me about your long-term care plans. That's it. And just their simple answer. And I don't try to sell them anything right then. Then I go into the Mike Stranka income presentation, and then I ask them those health questions. It's all on page 2. I think right now I have 6 or 7 open cases that have to address the long-term care issue. They have to,
Yeah.
because especially because one spouse is healthy and one spouse is not.
Mhm.
So if we run into one healthy spouse and one unhealthy spouse, are we talking 2 products, or are we talking one product that can be shared?
It depends on how the spouse that's unhealthy is unhealthy. I mean, it's just going to depend on this. I mean, are they completely uninsurable, or do they just have a couple hiccups that we got to look at before we apply? So it's a question of looking at those questions on that page, page 2 of the fact finder. There are some knockout questions there that they're going to ask you, that if they say yes to those knockout questions, then that's something I need to know certainly up front to move into like the Equitrust bridge conversation, where there's no underwriting on that. The other side is, if you can't get me health conditions, then just get me their medications. I will know 95% of what's going on with them health wise if I know their medications. I mean, if they're on metformin, they've got type 2 diabetes, and that leads into several other questions. If they're on metoprolol, that's metoprolol, that is high blood pressure. If you're on, a statin, that's cholesterol. Yeah, I mean, I can tell what's going on with people just by the medications they're on. So if you can't get me health conditions, at least get me medications and how long they've been on the medication.
Do you have an average premium?
It depends on, are you doing single pay? Are you doing 10 pay? Are you doing 20
Well,
pay?
let's say single pay.
Single pay, 100,000 typically is what people are doing. Because typically what you'll find is that people have been sitting on a CD that's maturing, that they say, I'm just sticking that money in the bank, and Randy, when I have a long-term care event, I'm drawing down off that 100,000. That's my long-term care plan, right? I had money in a CD, it's now matured, it's sitting there in money market funds, and it's safely there. Well, why would you leave $100,000 safely there in a money market fund when I can turn that 100,000 into 600,000 for long-term care, or 400,000 for long-term care? And if you don't need long-term care, your heirs are going to get back at least the 100,000 that you had sitting in that money market. They're going to get that back at least in the form of a tax-free death benefit.
So listen to,
There's
okay, I'm sorry, I didn't mean to interrupt you. Go ahead.
no. I was just going to say, you can't. It's tough to tell someone you can't lose with this, but you cannot come out of this typically with less money than what you put in to leave to an heir. And you can't come out of it for long-term care with less than 2 or 3 times what you put into it, or 2 or 3 times what you put into it for long-term care. I mean, there's no way to come out of this poorer than when you went into it.
So you folks that are our licensees, listen to when I talk to you about your power phrases, and you go in and you do the long-term care question, you do the income analysis, and you do the health questions, and you ask them for ballpark figures on their assets. And then after they have bought the estate plan from you, all you have to do is you need to say, I've been thinking about what we've been talking about. I have some ideas for you, but I need to do some research and I need to run some numbers. When you come back to pick up your estate plan, would you like to see those numbers? And everybody will say yes. And you can show them the long-term care. You can show them whatever you want to, but you don't have to be a pro at selling the long-term care. You have to be a pro at getting people to have the discussion, because people like Jean and Mike and everybody, these consultants, when you talk to them about the case, they'll make the right recommendations for products for us. So that's the easy part, or I'm sorry, that's the hard part, and they make it easy for us. But anyway,
and
Jean?
I would add, Randy, and when you're talking about like power phrases, when you ask someone what their plan is for long-term care, what's your written plan for long-term care? Then if they don't have one, or kind of avoid the subject or kind of rebuff you, then you say, well, if you needed long-term care, which of your assets are you going to liquidate first to pay for that care? We need to make a list of all your assets, and I need to know the order in which you want them sold to pay for your long-term care if we're not doing a long-term care plan. And we're going to need to constantly kind of revisit that list and update what you want to sell at what point to pay for long-term care expenses.
And to be honest with you, I think people think it's hard to get into that conversation. And what I'm trying to promise you all, that if you'll follow our agenda that we teach you all, you'll be guaranteed that conversation in every case you open. They can't have a total estate plan if they don't have the discussion about the proper funding.
Mhm.
So what Gene is telling you is solid gold. And to be honest with you, Gene, I wanted you to come on here so I could learn.
That's what I'm here for. That is
Right.
exactly what I'm here for. I mean, I've been doing this for 18 years and it's all I do. It is all I do. You guys are doing other things for your clients. So lean on me. That's what I'm here for.
Open it up to other questions. Anybody out there want to ask? I'm sorry I'm asking so many questions, but I just get excited about the opportunity that if you know that if you follow our program, you have to have that conversation with your clients. And when we tell you to find 10 suspects who might benefit from a conversation with you about their current estate plan, when 7 of them agree, you're going to have 7 conversations about long-term care on a very low pressure, high quality presentation that you can actually discuss about problems that they have never been able to talk to with each other or never knew how to talk to each other about.
So
So
Randy, I've got a question.
go ahead.
We got clients that have got 2 individual long-term care plans, one for her, one for him. And they were 10 years old. What's the best way of talking to them about converting that to a different long-term care or looking at that from that perspective?
Gene,
Yeah,
I'm sure
if
you hear that a lot.
Yeah. What I would say is if you've got plans that are 10 years old, unless they're coming to you and saying, I'm getting rate increases and you can help them, I can help them, help you to help them get those premiums down if they're having rate increases. But other than that, a 10-year-old traditional long-term care plan, like I said, unless they're getting rate increases, is really hard to replace. What you want to look at is the question of supplementing that with something layered on top of it. Find out, have them get a copy of their current statement of benefits. They need a current statement of benefits. So they're going to call up Genworth and Mutual Omaha or whoever it is and say, I want to know what my benefit statement looks right now. And then they're going to get that to you and I can analyze it and say, they don't, they probably need more long-term care coverage than this. If they do, if they don't, we'll know that too. And then at that point, you will have built trust with your client because you've looked at their long-term care plan. And if they're not short on benefits, you've had a completely altruistic conversation with them and you're giving them an altruistic answer of, no, you're fine. I don't need to sell you anything from a long-term care perspective. And that builds nothing but trust between you and the client when you say, yep, you're all set. Or, you know what, we look at the current cost of care and what the cost of care is going to be in 15 or 10 years. Are you prepared to co-insure this with your income, or do we need to get more coverage for you? Would you feel more comfortable having more coverage than this?
Well, I think you just made me another $100,000 next year, maybe more than that. And I appreciate it because
My pleasure.
Tell them where to send the tip.
That's right.
you know,
Buy
you
low,
know,
sell high.
so when I tell you the numbers work, if I tell you to approach 10 people and that 7 of them are going to give you an appointment and 3 of them are going to buy something, I mean it. And all you have to do is just decide how those numbers work and what your income's going to be. So you shouldn't think that you're not capable of making $30,000 to $40,000 or $50,000 a month. You shouldn't think that you wouldn't deserve that if you follow what you learned today. So a lot of people look at me and they can't see themselves as earning that much money. It took me a long time in my career to realize that I could earn a lot of money if I found out what people were already doing that made them a lot of money and just emulated it and copied it. So you don't have to reinvent the wheel. All you have to do is follow a system, find someone who's got a good system and use it and implement it. And if you have questions about it, go to them like a coach. Well, Jean right here is the best coach that I know of. Jean, I think we've bumped into each other or met a little bit a couple times at the Strength meetings.
Yep.
But there's 20-something people here. And if you go out and each of you approach 10 people, that's 200 presentations that are guaranteed to have long-term care conversations. And all
Yep.
you have to do is follow the family tree asset positioning, go to first interview.
Mhm.
So those of you who are slow starters, that's okay. Figure out how much extra you need to make. If you need to make $6,000 or $12,000, that's just one case.
Mhm.
And I think my averages are 200 or 300,000 most of the time. But Gina, I have a question for you. I have a lady that I have to see Thursday. She's got a $25,000 MIGA that matured when her husband died. Is
Mhm.
that too low an amount of money to use?
Not necessarily. It's going to depend on her age and if it's just $25,000 single payment into an annuity. I mean, we can definitely work with that. It'll give her benefits. That is
That's better than the 2.65% she's earning.
right.
Okay.
May I ask something? Sorry to interrupt.
Of course.
Do you have a long-term care product here in California?
Oh, tons. Yep, absolutely.
Okay,
We just
and
noticed that it was grayed out earlier. She and I were kind of talking about California had a gray.
Yeah, no, so the One American New Asset Care is going to probably be available. That product that we talked about is probably going to be available in California in like March of 2025. But in the meantime, we've got nationwide Care Matters 2, which is a life policy with a cash benefit attached to it. In California, we've got Global Atlantic 4 Care, which takes every dollar you put in and doubles or triples it for long-term care.
but does it have the same benefits as what you just said, that if you put it in, you transfer a non-qualified into it?
Mhm. The Pension
Um,
Protection Act is across the country.
so it would apply to those type of.
Mhm.
Oh, okay. I didn't know that part. So
Yeah.
everything, whatever they earn from the previous annuity and they pass it on, like you said, carries it on based on that act that you said, and
The
every
Pension
time they
Protection
pull it
Act.
out, it's tax free.
No, but only for long-term care. Only if you're pulling it out for long-term care expenses is it tax-free.
And on the 4Care, that is reimbursement though, right?
It
It's
is a
not.
reimbursement contract. That is correct.
Okay, got it. Okay, and then the rest that you were mentioning, it's basically life with long-term care.
Yeah, the we've got with One America, we've got annuity care 2, and indexed annuity care, and Global Atlantic has 4 Care. Other than that, other than those products and outside of California, we have the Equitrust Bridge product, which is the no underwriting product. That's only outside of California. Yeah, I mean, other than that, everything is life insurance with long-term care built into it.
Oh, okay, got it.
Mhm.
Okay, thank you so much for answering.
Sure, of
Appreciate
course.
that.
Well, I could ask questions all day, but I'm not going to hog anything. I don't know what your time frame is, Gene. But if
No,
there's
okay.
anybody out there that's got a question, now's the time to ask it.
There's some questions in the chat.
Oh,
Go ahead. Go ahead and read them off to her, Lisa.
Okay, Gray asked, who do we contact for contracting?
oh, you're gonna reach out to, yes, Win, and then yep.
Yeah, and we'll send them to, we'll send you to Gene and to Mike and to, we'll get contracted with
Yep.
them.
As soon as you let me know there's an interest, I type up an email and I introduce you to Mike. And then Mike will introduce you to the rest of the team.
And you guys that are out there listening, there were many years ago, 7 or 8 years ago, I had no respect for Mike, and I called him a whippersnapper. And I said, "What can a young guy like you teach me?" And he has done nothing but, I'd say he's increased my income by 500%, easy. So Mike's super. He's good. If you're looking for a home, go there. Mike, and everybody will treat you right. And the good thing I have about it is when I say, "Hey, I need to do some research and run some numbers," and they say yes, I call Mike and I say, "Here's the information I have. You do the research and run some numbers and send them to me, and I'll go talk to the client."
Right. That's exactly right.
That's what works. When I tell them that I've got the 3 to 5 best solutions that we've already done, and that I've already done the research, I have done the research. I called Mike and he did the research and sent it to me, and I trust him, and I know it's the right products, and people buy them.
You guys are some of the luckiest people in this industry. You have got a team that wants to back you, that wants to train you. Everybody that you see here will absolutely answer an email, answer a text message, answer a phone call. Make sure you get full training on anything that you have any questions about. You just have to tell us.
And just
Absolutely.
remember, you can go out and hunt and peck. You can go out and hope that you're going to run into something good, or you can ask somebody one question that leads to everything. And all you got to do is say, "I think you would benefit from a conversation with me about your current estate plan." And if they say why, you say, "Because you might learn something in which you were not aware." They'll make the appointment with you, and you won't, within 30 or 45 minutes, you'll be setting up an estate plan and telling them about telling them that to properly fund it, that you need to have a long-term care discussion, you need to have an income discussion, we need to have a health discussion, and we need to get a ballpark review of your assets so be sure that estate plan is properly funded. You open the door to everything, but once you do the long-term care question and then turn around and ask the health questions 15 minutes later, you know who's closer to the cliff. You know who is at the biggest risk, and it's the healthy spouse, because the unhealthy spouse might drain assets.
Yep.
So you're not out selling product, you're out talking conversations about the rest of their lives,
And meeting needs.
and finding the proper gaps and the proper cliffs and the proper structure for what's going to happen to them over the next 10, 15, 20 years. And you know what? Go ahead, Jean.
Oh, I was gonna say, I saw a question pop up if they say they want to talk to their regular financial planner. Typically, what I ask there is, no problem. Is your financial planner a long-term care specialist? That's one of the things that I would be asking. Because most of the financial planners out there that I work with, either they're working with me, or if they're not working with someone like me, then they know one product. And that one
And I
product.
want to know why they haven't told me about it before.
Yeah.
Well, the real answer to that is why have they not had this discussion with you already? But and I think Mike Bemis is putting on a "How to Fire the Broker in the First Interview" video this week. If y'all are interested, send me a note and I'll get you the link to it. Sometimes you do have to fire the broker. A lot of times, but the brokers, the last broker case I went into was $640-something thousand. And when I went in to tell Eddie on the corner what we were going to do, he looked at me and he said, "That's amazing. We can't do that." And he had no problem with taking $640-something thousand out of a $2 million portfolio, and making sure that it went over to where it belonged in the annuity company. And I'll never forget it. He just looked at me and said, "Randy, we can't do that." So don't be shy. Just go in there and be sure that you're talking to your client about their lives, their plans, their current health situation, and that couple. You're talking to a couple. I promise you, they will thank you for helping them have a conversation with each other that they didn't know how to have. That's a big part of the sale right there, and it's your ability to create the situation where you go back for that second interview, where you're going to make the most money. Be good at the first interview and know that you're going to go back on the second interview and close it. Question? I'm sorry, I'll hush again.
No problem. I have another Zoom call at 2:30, so I just have to be out of here at 2:30.
Okay. Any other questions?
Yeah, Eastern time, sorry.
Lisa, got any more questions?
Felicia asked, could you please put the name of the book on the chat, in the chat?
Oh, sure. Well, the book that I can send, I can send you a copy of the PDF of the book, so you have it.
That'd be great. And then instructions for them on how to do the branding thing that
Yep,
you had talked
yep,
about. If
yep.
you'll send that, I will send that to anybody who's interested. Of course, the ones that are contracted with Simplicity.
Mhm.
And if you're not contracted with Simplicity and you want to, get me an email. Lisa can put my email address in the chat.
I will do.
And if you don't feel like you've got the training that you need, I'm happy to work with you one-on-one. We'll hold your hand until you're comfortable, whatever you need.
And the last thing I'd like to add is folks, I'm an agent just like you. I had to figure out how to maximize the use of my time, how to maximize my income. You know, Simplicity and people like Jean, people like Bemis led me through that process and led me to the creation of the sales presentation that I teach you, because I kept listening to everybody, kept listening to Mike Stranka, and I kept going, these guys are wonderful at talking about the income presentation. I need to teach people how to get into the need to have the income presentation. And that's the weakest point. So anyway, I'll stop right there. Jean, you were wonderful. I'm going to make some money tomorrow and Friday, I think,
Okay.
from this conversation.
Let me know if you need anything to look through medical histories or illustrations, whatever you need. Just everybody just let Mike know or Les know, and copy me on anything else you need. Okay.
Okay. Thank you.
All right. You guys have a great week, and we'll talk to you soon.
See you at 3.